Share Shootout brought to you by Lion of Africa Insurance, insuring South Africa's future.
It's hellish, it's backbreaking, it's downright relentless. It's Share Shootout right here on CNBC Africa, first in business worldwide. I'm Bruce Whitfield, the host, judge, juror and executioner. Now, was the former Fed chair Ben Bernanke spotted in Sandton City at the Woolies sale? Will South Africa ever get a legitimate interpreter? I think I just said pack your bags and go. Did Graham Smith retire from cricket so that he can go and spend some more time with his family in Ireland? Now, we don't know the questions to these, the answers even to the vexing questions, all questions to the vexing answers. What we do know is we have a man who once worked on a chicken farm in the UK and another who's much better at watching rugby than actually playing it. Introducing the top dog, 5 appearances, 4 wins and 1 loss. Andrew, who's your daddy Dittberner from Cannon Asset Managers. Nice to see you, Andrew.
Thank you.
And with 2 appearances, with a 50-50 ratio, 1 win and 1 loss. Byron, the king of the Amazon jungle, at least he was until he came back to the concrete jungle. Lotter from Vestact. The names are getting longer and longer. No working during drinking hours. Those are the rules. Seriously, our guests are pre-picked 3 shares. Kinda like poker. Neither knows what the other holds, but each must accept at least one of their competitors' picks, and the longer they leave it, the more likely they are to have to accept something they really don't like. So who should we make go first? Andrew Dittberner, you're a regular, you're a champion, you are the king of the heap, you're at the top of the pile. I think we should make Byron go first.
Sounds good.
I think we should. Byron, lovely in camel today, which is very nice to see. Did you buy those in Brazil?
No, I got them the other day actually.
Hopefully on sale.
Guess.
Where?
Guess.
Where? Oh,
You do that.
oh, guess. Okay, so there we go, Andrew Dittberner. We're going to make you go first, I think. Was Byron, poor Byron. He's known for those trousers. Really, we'll keep him guessing. Why don't we, in 30 seconds, have your first pick, which is Trencor.
Yeah, Trencor is quite an easy business to understand. They own just less than 50% of a company called Textainer, which is listed in New York. Textainer, they're the world's biggest leaseor of 20-foot equivalent containers. Those are your containers that sit on the back of ships. If you look at the underlying assets, it's been profitable for 27 years now. It's had stable or increase in dividends over that time period. And when you look at the leases, over 80% of the containers are on a long-term lease, which is 5 years or longer. So it gives you great visibility of the earnings going forward.
Okay, there we go. So Trencor, you like it. Byron, I bet you don't.
No.
Why would you not like Trencor? It's a fabulous business. It's world trade. Global economy is improving. It's a unique South African business. There's nobody else doing it in this country to the same scale as Trencor is doing it. Why don't you like it?
Unfortunately, those type of freight businesses are extremely cyclical because they're so capital intensive. When times are good, they make lots of money and they have done well. But when times are tough and there's less demand for their product, they sit with that high capital doing nothing.
But are we not going into an environment, Andrew, where precisely the opposite is happening that Byron suggests? We are seeing greater demand. We are seeing a pickup in trade. We're seeing the Chinese targeting 7.5% growth, which, fair enough, is not 10 or 11%, but it's still 7.5% on a bigger base.
Yeah, exactly. I think if you look where we've come from over the last 5 years, I think you could say that we've been through the worst. The global economy is slowly starting to pick up. And as I said, 80% or more than 80% on long-term leases. So you can see there's a very nice earnings visibility of what they're going to do over the next 5, or at least a base case of what they're going to do over the next 5 years.
But when you're stuck in
really
Byron's rut, you'll find it hard to see, I suspect. Hey, Byron, you just don't get Trencor, or you simply just don't like the sector and the industry?
It's when you're investing for the long term, it's not often how you do during the good times. It's how you're able to cope during the bad times. Jamie Dimon's famous for saying that a banking crisis happens at least once every 7 years. So, do you really want to be holding this business over the long term? I don't think so.
All right, okay, you got to shoot it down then.
Yeah.
You shot down, I'm afraid, on that one. I like Trencor. I think it's a good pick. So, Byron, who knows nothing. And he's going to prove it now with his first pick. Are you completely insane? This is a company that rode out the last load shedding crisis of 2008. It was bringing in generators, then got stuck with a whole bunch of stock when the lights didn't go out. And now, just because Eskom just last week has declared an emergency with power, you think that this is going to breathe new life in 30 seconds to Ellies?
Now, Ellies is a stock that I like to call speculative, but a safe speculation, because they are waiting for some big one-off profits to come through if that migration does happen from analog to DTT. But at the moment, that's not priced into the share price at all. At the moment, you're buying a very sound business for electronic consumers at a very, very good price. So you have limited downside and a lot of potential upside.
Okay, within his 30-second time frame, which means he's showing off and he's feeling confident about his Ellies pick. But just give me a picture of the share price over the last 18 months. What has happened to it?
Yeah, this is definitely a bit of a contrarian view. I think the share price has more than halved over the last year.
Which means it is half as expensive as it was a year ago, which means it's a bargain. And
it's been sitting waiting for a long time for government to eventually shift, the SABC from analog to DTT, which means that you're going to have to buy a decoder in order to get SABC. The quality is going to be a lot better, but Ellies have geared themselves.
The picture quality, you'll just see the rubbish they broadcast in greater clarity.
But they also involve very much with multi-choice. They provide all the hardware, the controls.
I buy the arguments, but we've been waiting for this transition to DTT for an awful long time.
The deadline's 2015.
Yes, and it looks like we're going to miss it like so many others. Remember
but
the
like
power
I said,
stations?
this is not priced into the share price. So you're buying the current business, the current operations with potential huge upside.
There we go. Okay, Andrew, shoot it down. I mean, what do you think?
I think Ellies is an interesting. I'm caught here a bit. It's done really well. I think with the Eskom contract 2 years ago, we saw the share price go through the roof. Now we've seen, when that Eskom contract's fallen by the wayside, the share price has halved. It's got a lot of blue sky. I do buy the arguments with DTT. If you're a long-term investor here and you hold this, if you've got to wait a few years for that to come online, I think it's at current valuations, I would be willing to. And
that's a great difficulty you face. That even if you didn't like it, at a multiple of 7.5 times, you've got to have a very good reason to believe it's going bust.
Yeah, I mean
and you don't.
No,
not for a moment.
No, and we're a deep value manager. This is exactly the sort of space that's small cap, big potential to grow. Trading on exceptionally attractive multiples. I'm going to have to accept this one.
He accepts it, absolutely. So, Byron, you won ahead so far. It's on a multiple of 7.5 times, which makes it very hard to shoot down unless you believe it's going bust, in which case you can't take it, because we've seen lots of shares at multiples of 7.5 before they've been to multiples of 3. Okay, let's move on then into your second stock pick, Andrew Dittberner. This is an interesting one because it is one of those great recovery stories, and we've seen a great recovery story coming out of Old Mutual in the last years. You've worn a green tie in sympathy today to show that you're nailing your colours.
Cannon green.
It was the cannon green. It was a brilliant buy at $5. At $35? Really? 30 seconds.
I think Old Mutual is priced as a developed market or developed world life insurer. It's obviously headquartered in London, listed on the London Stock Exchange, and we don't believe that at the current multiples, it shouldn't be trading at the current multiples, given that it's actually an emerging market life insurer. 80% of the earnings come from emerging markets, 75% come from South Africa. If you take a sum of the parts, they own 55% of Nedbank, which makes up a large chunk of their market cap. They've got Mutual and Federal, and then they're listing the big, or what they've been talking about for a long time, the US asset management.
There we go. 30 seconds up. Did you see the Mutual and Federal results, Byron Lotter? They were diabolical. They've got a real problem with Mutual and Federal, don't they?
Yeah, it's a tough business, and there's a lot of moving parts there. I mean, we saw results come through from Sanlam the other day.
Santam, yeah.
Sanlam.
Sanlam on Thursday, and then the Santam before then,
yes.
right?
And they were fantastic. Okay. So the insurance businesses are doing really, really well. My biggest issue with Old Mutual is, do you firstly understand all the moving parts? And even within those moving parts, you've got Nedbank with a lot of other moving parts. So there's a lack of transparency there. The other thing is, when you're looking at a business like this, a lot of their returns have to do with asset management. And surely as an asset manager yourself, you can back yourself to outperform their asset managers as opposed to relying on them and paying their fees.
You see, he looks like such a nice bloke, but actually deep down he's a mean SOB. And it's a valid point. It's a very valid point. You're basically outsourcing the management of funds to another manager. And they're adding a layer of cost.
Yeah, if you look at, Old Mutual's got a market cap of 170 billion rand. And if you take a sum of the parts valuation on it, and you take what Nedbank's worth, and I buy the argument, there are a lot of moving parts, and we do tend to lean towards businesses that are easier to understand.
Sure.
Old Mutual are moving in that direction. They sold the Scandia business a few years ago. And if you take that US asset management business that they're going to list, now that's got $260 billion under management. If you put that in rand terms and apply a multiple that Coronation, for instance, is trading on, that makes us...
not even the Coronation guys believe their own multiple.
No. So I'm highlighting how expensive Coronation is on one side, but also you can put we think a fair value multiple is probably 2% of your assets under management. If you go at 1% assets under management, it makes up a large chunk of the Old Mutual market cap. So when you add up all those different sums, you actually get more than the whole, and there we think is your upside.
It's a big bet for a deep value asset manager to go into another asset manager and look at it as and the thing is, it's done so well, and that's a concern as well. It's consolidated, it's really done nicely. Where is the next growth going to come from? And they're heavily dependent on South Africa. They need to diversify. And that diversification, Byron, takes an awfully long time to bed down. They're buying businesses on the African continent, they're in Latin America, they're all over the place. But it is a concern that the best is possibly past the share, at least in the next couple of years.
Yeah, a lot of these businesses are trying to diversify, and there's no secret that Africa is extremely underinsured. So there is a lot of potential. But like I said and mentioned earlier, I shut it down on the basis that I'd back ourselves to outperform the stock.
Shut down, I'm afraid, Andrew Dittberner, which means you're going to have to work really hard on your final stock pick, or not hard at all. I cannot wait to see how he explains his acceptance of your final share, because I don't think that it's going to be on his radar particularly. Righto, Byron Lotter from Vestact. This is an interesting one. It's been a favourite of Vestact's for an awfully long time. Through in the boom times when they were building lots of hotels and we were warning them that they were going to have too much capacity, they've finally grown into that capacity, and maybe now the money will flow to the bottom line. City Lodge in 30 seconds.
I really like the exciting Africa story. I did some calculations the other day. City Lodge's average profit per room is 170 Rand. They've got 2 hotels in Kenya. The average profit per room in Kenya was 770 Rand, more than 4 times. So the potential for further expansion up in Africa is huge. They've grown their room capacity by 40% over the last 3 years, but occupancies have come down. When those occupancies start leveling out, even at about 70%, which is below the average of 80%, there should be a huge profit booster for the business. Plus, there's a massive property underpin.
30 seconds are up there. It's a good story. It's a good story, Andrew. Are you tempted to take it, even though it trades at a multiple of 18 times? It's a good story. It's got incredibly good management. I wonder how long Clifford Ross will continue in the job there. He's been there for a terribly long time, but he's been a good custodian of the business that was started by Hans Enderley. Yeah,
they've rebranded as well, and I think that's worked in their favour. The thing I like about City Lodge is the property underpin here. Yeah. They've got fantastic properties around the country and up in Africa, and I think if you take the value of the property, you might be able to justify the multiples that you talk of.
Profit per room in Kenya of $700 versus 170, and Carmare makes what, 30 Rand a seat on an aeroplane. I know which one I'd pick.
Yeah, and when you look at, I looked at the Sun International results recently, and whilst the casino side of the business is battling, the hotel side is doing really well. So I think, if you take a City Lodge as a hotel or a property company for that matter, it's a very nice story. But
I'm feeling that he's about to shoot himself in the foot. But before he does that, on this one, Byron, I mean, the City Lodge story, the fact that there is this enormous profitability happening on the African continent. We've seen American hotel chains come in. We've seen the deal that Protea has done, for example. The rest of the world is looking at the African hotel sector with a lot more interest than it was 5 years ago. Is there not the risk of competition, and to see those profit margins getting smashed in places like Kenya as international competitors come in?
Well, when you've got huge profit margins, there's always risk for big competition. But I remember when the African Cup of Nations was in Angola a few years ago, and it highlighted the country as being one of the most expensive countries in the whole world.
Absolutely.
And that just shows, and that was focused on accommodation and hotels and so on. It just shows that there's still so much room for growth, and coming off a low base. City Lodge are also very focused on business travel.
If it was up to me, I'd just take it.
No,
how are you going to shoot that down?
I'm not going to take it. It's a great story, but I mean, there's lots of great stories on the JSE. For a deep value manager, Ellies, it's on a PE of 7 with a nice story. good stuff.
Okay. Nice story without
City
deep
Lodge
value.
Without deep value. No, I'm going to shoot it down.
I think he's just been petulant myself. But
I think he had to shoot it down.
I think he had to shoot it down. Secretly, I think he likes it. Who will prevail? Who will go away? You won't want to miss the final share picks as we go through Byron's share picks of Ellies and City Lodge. Mercilessly shot down with City Lodge by Andrew Dittberner, who's being as mean as Byron can be. But Ellies getting the big fat thumbs up from Andrew Dittberner. Andrew Dittberner's picks this evening: Trencor and Old Mutual, both blown away, and not in a good way. More in a moment. It's a fabulous episode of Share Shootout this evening, only on CNBC Africa, first in business worldwide. Before the break, Andrew and Byron both gave us each of their stock picks, and we had from Byron Ellies and City Lodge. Ellies trading at a multiple of 7.5 times historical earnings. The share price has halved in the last 12 months. A little bit of load shedding may very well go their way. Plus, of course, there is this long-awaited movement from terrestrial to digital television that both gentlemen on my right this evening agree will be good for the company. So Ellies getting the big thumbs up this evening from Andrew Dittberner. City Lodge, great company, great business, 5 billion rand market cap, huge profit margins being made in other parts of the continent as to where they're expanding. Andrew Dittberner, however, strategically shooting it down, but we don't believe him for a minute. And then, Andrew, your picks this evening, both Trencor and Old Mutual. Compelling arguments, particularly for Trencor. Old Mutual, not as much upside perhaps as one might find in an Ellies, and both of those have been shot down. So let's get into the final picks. Byron, let's go with your final pick first, because I really want to see you sweat as Andrew reveals the pick that you have to accept, or find at least a reason to accept this evening. I'm interested into why you like the fabulous, the magnificent, the spectacular, but too expensive for Andrew, Omnia Holdings in 30 seconds.
Okay, well, this stat should blow your mind. Did you know that 65% of the world's arable land is in Africa?
Yes, I did.
Okay, well, that's good.
But it blew my mind the first time I heard it.
Do I get extra seconds?
You get an extra second.
Omnia are on the forefront of fertilizer when it comes to farming in South Africa. They're also very much involved in mining. They provide the explosive for open cast mining throughout Africa, which is also very resource rich. But they don't take the operational risk. They're just the suppliers. So when you think of African growth, you're going to think agriculture and you're going to think resources. Omnia are at the forefront of that business.
And your 30 seconds is up. Right, Andrew, you can't not like Omnia, other than it's on a multiple of 17.5 times. Ignore that for a moment and then come back and shoot it down. No. It's a lacquer business in a really good sector, and the arguments are impenetrable.
No, it's a great business, and if this show was filmed 2 months ago, I would happily accept it. Yeah, it's got 3 divisions: the mining, chemical, and fertilizer business, and generally 2 out of those 3 are firing on all cylinders. So it's a nice defensive business from that point of view. The Africa exposure, which Byron talks about, is fantastic, and these guys have done everything right. That nitric acid plant that's come online, I think a year or 2 years ago, that did it. I mean, that was a huge capex expense. They did it within time, under budget. So management, I mean, they've shown that it's a fantastic management team.
When does it pay a decent dividend, though? At what point does it actually start paying a decent dividend? Because it's nice and expansionary, and that's all well and good, but as a shareholder, you want to get some cash out of it.
Well, as Andrew mentioned, that nitric acid plant took a lot of money.
Yeah.
And I think they're still very much in expansion mode. The margins are still quite small, especially in the chemical business, and they're still well below their margin target in terms of the fertilizers. So I think we've got to wait to see that margin expansion start coming through, especially with the synergies provided by that nitric plant, and then we might see the business being more cash generative. But I think at this stage it's still in expansive mode.
That should be enough reason for you to shoot it down then, Andrew.
Yeah, as I said, we used to own this business. Yeah. I think we sold it in December, purely from a valuation point of view. So for that exact reason,
kaboom!
I have to shoot it down.
Omnia is shot down. Okay, right. Let's move on to you then, Andrew Dittberner, for your final pick this evening. So far, you've given us Trencor. You've given us Old Mutual. Both have been shot down so far. So I'm fascinated to see how much of a hard sales job you need to do on the construction sector, because in particular, Wilson Bailey Homes Ofcon in 30 seconds.
Yeah, we've liked the construction sector for a long time now. We're probably a little early, but if you're looking at a construction company right now, From a quality point of view, I think Wilson Bailey Homes is accepted as the best quality construction company. When you look at its earnings growth, cash generation, the execution of the jobs that they're doing a fantastic job. They probably had a bit of reputational damage last year. But when you look at their balance sheet, they're very conservative. They've got lots of cash, which helped them get through those difficult times after the World Cup. Valuation's attractive.
Valuation's attractive. I looked at the valuation of 13 times, and by your own deep value assessment, that's pretty expensive. Byron.
Yeah, I agree with Andrew. I mean, Wilson Bailey are by far the best operator in that sector. And I think the best measure of that is their margins. They've got the best margins out of all the construction businesses in an industry where margins are very thin. So, when you have a look at what happened with the US market after the recovery, it took the housing and the building sector about 3 to 4 years to start recovering after we had the financial crisis. So I'd expect to start seeing that coming through into South Africa in terms of our construction industry.
We're seeing a boom, for example, in the UK construction sector, especially in residential building, because they've got a real housing crisis there. We've got a real housing crisis here. Do Wilson Bailey build houses?
Not really.
They've
done a few residential things over the years, but that's not their core work. You can drive down the road here in Sandton and see what they really do. ProBuild in Australia, I think the Australian business now makes up more than 50% of the order book. Public sector jobs are less than 11 or 12% of their order book. So when there's all the talk about the infrastructure spend, they're not reliant on it, but if it does, or when it does, hopefully come online, there should be uptick there for them.
Byron, you have to take it, but do you take it with a heavy heart, or do you take it with a spring in your step?
Well, we're patient investors, and we've got patience on our side, and we've got time on our side. So I think, the cycle will turn. And we've seen what can happen during the boom days for our construction companies, and they did fantastically well. So if you're willing to hold this one and be patient, I think it's a good call.
You may have time on your side. Paul Theron. Okay, let's pick a winner, because what we've got to do the next time we host Share Shootout is to keep it fierce and feisty and ferocious. What we got from Andrew Dittberner this evening, his picks were shot down. Trencor and Old Mutual were obliterated. Wilson Bailey Homes, slightly reluctant take, but over the long term, says Byron, he would take Wilson Bailey Homes. And then Byron's picks this evening of Ellies, very adventurous, but interesting time in the electricity cycle in South Africa as Eskom keeps its finger on the trigger. City Lodge, love the story. Andrew doesn't, so he loses points for that. Omnia Holdings, also a fantastic story. Sold by Cannon Asset Managers in December, shows that you liked it. So now I have got to do the difficult thing of choosing a winner. Despite his trousers, I think we should keep Byron. What do you think, producers? Do we keep Byron, or do we let him go? Touch and go. Producers say, Byron, you should go, but I think you should stay. I overruled them. Goodbye, Andrew Dittberner. See you in space. Which brings us to another end of Share Shootout for this evening. Well done to Byron Lotter from Vestact, who improves his standings considerably on the show. We'll host another Share Shootout stock picking battle royale next time here on CNBC Africa. Till then, tweet us the stock pickers you'd like to see on the show so that we can bring them here and humiliate them. Until next time, bye-bye.